Hi, everybody. This is Hyperwave, and we have a lot to talk about today. Powell, we're going to talk about, all right, well, Thor's going to go nuts, so I'm going to turn it over to Tyler pretty quickly. But gold, traditional markets, I mean, everything's going a little bit insane, but especially what the Fed meeting today means. Especially there's a lot of FOMO, especially in our Hyperwave chats, and, been getting great questions about, what does interest rate, oh boy, Thor, he's eating a lion. Interest rates mean for inflation? What are we looking at? Actually, I'll leave it there, and I will turn it over to Tyler to tease you off and then explain everything. Ty?
Great, thanks, Leah. Last week we said that this was going to be a very important week because there were a lot of crucial things happening technically, with the stock market either breaking up or breaking down, with gold either breaking up or breaking down, with the dollar either breaking up or breaking down, with interest rates breaking up or breaking down, with oil breaking up or breaking down. And none of that had been resolved over the past 2.5 months. All we did is we climbed back to where we were, and then we stopped going up. With the stock market, we stopped going up at around 2,600 to 2,800 on the S&P, and the Dow didn't even do that well. With gold, we ran up to 1,350, couldn't get any higher, slipped back below 1,300. The dollar has been stuck between 96 and 97, went a little bit over 97 today, went a little bit below 96. And all of these things are telling a story, and nobody knows what that story is. I mean, we all know that there's two sides to the story. We're either going to continue up in the stock market, in which case we will break to new highs and keep on going. Tone Vase believes we're going to break to new highs and keep on going. I believe we're going to break to new highs and keep on going. Hyjin Lee yesterday did an S&P analysis that I would suggest people listen to, regardless of what you think about Elliott Wave or Hyjin Lee. It's always good to get someone else's analysis. And he blew my mind yesterday with an S&P that we will pull up on our screen, not the Elliott Wave, but this huge inverse head and shoulders that were within a gnat's butt hair of breaking to the upside. And if we do, we're not only going to go to new highs, we're going to go way to new highs. If we go just a little tiny bit higher in the stock market, we're going to run from 2,800 all the way to 3,300 like that. Well, his analysis was that if and when that occurs, we will keep on going to 4,000 to 4,500 to 5,000 to 5,500, maybe to 6,000 on the S&P in fairly short order, meaning in the next 3 years. Well, that's a totally different view of the world than everybody else in the world has, except for Tone, who thinks it's going to break out, not so big this year, but definitely in the next year or two to not only new highs, but a lot higher. And I'm still on record saying that I think the Dow is going to 100,000 in my lifetime. And I've been saying it since we were below 10,000, and we've made it all the way up to 25,000. But these are big, big issues because of what you all know, Leah and I believe to be this overriding huge problem caused by the Fed. And the Fed spoke today and really roiled the markets. And we need to go into that because that is occurring precisely during the week in which all of these important things are going on in the stock market. Now, on the stock side of things, we said we think things are going to break up, but I'm very nervous that sequential has got nines all over the place, red nines, saying that's as far as we're going. Some of them started to occur last week, some are occurring this week, but they're in all the big indexes. They're on dailies, they're on weeklies. At the same time, I pointed out that I've got three big broadening tops going on with the S&P, the NASDAQ, and the NASDAQ 100, which have very negative implications. I said that about the NASDAQ a year ago, and we basically never got higher than that broadening top before going into this 14-month correction. So a lot of very big things happening. And the reason I'm talking about the stock market right now is because everything else is pinned on the US economy and the US stock market. Everything meaning all the other world economies, all the other world stock markets, all the other world currencies, all the interest rates around the world. And I'm going to show you some mind-blowing charts in just a second that all occurred within an hour and a half before and after the Fed meeting, which would lead everybody to believe that the Fed did something unbelievably dramatic, and some very smart people said that they did, even though they left everything unchanged, basically. So we got a lot of stuff to go over, and it's very important, and the best way to do it is going to be with charts. And so I am going to start pulling up some charts that I put together just for today's vlog. And we will start with this one right here. And then we will go to this one. Okay, what we're going to start with is the S&P 500 with the pretty rainbow on it. Now, here's what I mean. This is the S&P weekly. Here's the 9. Here's this big down 8. And right after this big green 8 and an A13 on the 6 and an S13, sequential 13 this week, you'd expect 1 to 4 weeks of pullback. So that would be okay, 1 to 4 weeks, and maybe it's just 1, maybe it's 2. And today, right before, I'm going to go to the daily, right before the, I'm going to take it down even lower. I'm going to take it down to a 15-minute chart. Here's basically what happened. The stock market was moving down. The S&P was moving down very sharply, was down 20 points here on this 5 candle. Which occurred dropped all the way down to a low of 28.12. The high was 28.19, but the high earlier on was all the way up here at 28.50. We'd been coming down yesterday and the day before. I'm trying to find a good way of showing this. But basically speaking, Here is the Fed decision, followed by an explanation by Powell of why they did what they did. And we basically came all the way back down on this 60-minute chart. So all of this action occurred after the stock market had been coming down and coming down and coming down all morning long. We were down 200 points on the Dow, and then the Dow went positive on this news. The S&P was down 20 handles. At its low, the S&P was at 2812 and then ran all the way up to 2839 just on the Fed announcement. So what was so important about the Fed announcement? The Fed did 4 things today. Number one, the Fed said we're leaving interest rates unchanged. Everybody expected that. Number two, they said we are not, the Fed governors voted, and 17 out of 20 of them voted not to have any more increases in all of 2019. Whereas at the last meeting, they expected 2 increases. Everybody thought maybe there would only be 1 increase. Today they announced that the vast majority of Fed governors voted that no increases in all of 2019 and only 1 in 2020. Extremely bullish. But then they also said, number 3, that they were going to have a terminal date on rebalancing their, or unleveraging or rebalancing their balance sheet, and that will be September, which was of this year, much earlier than everybody else thought. Very, very bullish. And finally, they just said the economy is weaker than we thought. We, for the second meeting in a row, are lowering our GDP numbers for all of 2019. Originally, they were at 2.3%, then they came down to 2.2%, then 2.1%. Okay, those are the 4 main things the Fed talked about in their statement today. The result was this tremendous up, this tremendous down, and first down all day before the meeting, up sharply into highly positive territory. The NASDAQ actually ended up 31 after being down heavily today, and the S&P ended up down, up over 10 handles or 10 points after the Fed announcement, but then it gave all that up and fell 8 and closed down 8. So wild activity. Net, what it did is, following this sequential 9, we now have a green 1 that went way above the green 9, but now we're sitting right on it, the closing price of last week's 9. And could be a reversal candle, which is one reason we said last week this is going to be an important week, and therefore everybody be on their toes. I don't know if we're going to break up or down, but I'm leaning to the downside for the next 1 to 4 weeks. Okay, let's quickly just take a look at the NASDAQ. The NASDAQ continued up off this 9, a green 9, and now we've got a 1 and a 2, with the 2 above the 1, both of which went well above the red 9. That's the NASDAQ 100. On the NASDAQ itself, composite, it did exactly the same thing. You had the green 9, the red arrow. We then follow it with a week that went above the 9, and now we've got a 2 above a 1, green 2 above a green 1, negating the 9 and saying we're up, up, and away. On the other hand, you've got the Dow Jones Industrials, which never made the 9. It reversed down on this red 1. Now we've got a red 2 and a very nasty looking reversal candle. We've still got 2 days to go. This is only Wednesday. This is a weekly chart. So now we're getting a differential between the S&P, the NASDAQ, and the Dow Jones Industrials. If you take a look at the Dow Jones Transports, the same thing. Green 8 never made it to a 9. We have a big down 1. We've got a red 2, which was a green candle. And today we were down big all day long and closed down, regardless of what all those other indexes did. So the Dow Jones and the Dow Jones Transports are looking weak relative to the tech-related NASDAQ and S&P. Now I'm going to just throw another one on here real quickly, which is the Russell 2000. Small cap stocks down all day long. Green 9, red arrow, red 1, red 2. The red 2 isn't below the red 1, but on this day of wild activity, and for this week, Monday, Tuesday, and Wednesday, it's looking like all we need is a little bit more down. Starting next week, we could get a red 3 below a red 2, and that is not looking very good. Notice what all of the moving averages are doing. After breaking above them, they are now all coming together right where we are this week. How do I interpret all that? No interpretation. I am not ready to put cash to work into the market. I'm not ready to sell any equities away from the market. Now, this had a big effect in every other area of the market today. If we take a look at gold, gold had a big down where it broke 4 weeks ago below both the short and intermediate term moving average, moving them both down. It was on that candle that we exited our long positions in GLD and GDX as the mining companies and the bullion. Since then, we've had 3 weeks, all red, 2, 3, and 4, but all green candles getting higher and higher. And what happened today, if we pull up a hourly chart, you can see what happened right off of the meeting of the Fed. Gold went crazy to the upside and now is pulling back in after hours. And one of the reasons for that is what happened to interest rates and the dollar. Here is what the dollar did on an hourly basis immediately following the meeting with the Fed and their announcement. One of the biggest, this is hourly, so I'm going to go to, it's one of the biggest hourly moves I have seen in the dollar in a very, very long time. So let's go a little bit bigger. Let's look at the daily. And even that was pretty impressive to the downside. The dollar, which had been climbing between that 96 that I was talking about and the 97, up until this 9, and then a sell-off, didn't make a 9 here, sold off. Today we had a wick low that got all the way down to 95.74, which is lower than the dollar DXY has been since all the way back over a month ago, February. That's one of the big reasons we had that move in gold today. Was the move in the dollar or in gold significant enough? Here's the weekly dollar, significant enough for me to change my mind about what's going on with the stock market or the gold market or any of these other markets? No, we are still in a consolidation. Here's the dollar on a weekly basis, and we're sitting right where we were all the way back in August of last year. We went lower, we went higher, we went lower, we went higher. Just as we have done on the gold market, if we take it back further, I've been saying that I need to see it above 1380 and hopefully above 1400 because of these three tops in gold. And we sold off, we came all the way back, then we had this big candle down, and now we're trying to get back up with this big move that we had today. I want to show you some things with what happened with interest rates, because almost no one, including a very large panel on CNBC, expected what we saw. This is what, on a weekly basis, the 2-year notes have done since this buy aggressive 13 on this big one candle back in November. This is actually the price of the 2-year notes. So you've got to reverse this in your mind to see what the yield is doing. The yield is falling very, very sharply. And that will show up better when we look at the 5-year yield. This is what it did on today's action. This is for the week. I'll bring it down so you can see what actually happened on the day today. The yield, which had been caught in this sideways range, but coming lower and lower and lower since we were all the way up here at 310 and even got a little bit higher than that back in October. Yields have been dropping sharply, but they've been trying to hold in this sideways consolidation until today. And you can see that all the action, including the close, is lower than we have been on this entire move. In other words, interest rates collapsed. Usually that means very weak economic activity. And part of that is because of what the Fed said about what is going on with the world economy, and that they are lowering once again the growth rate of the United States. And that's the way the 5-year reacted. Here's the 10-year note. Now, the 10-year and the 2-year spread actually grew, even though both of them fell sharply. The 10-year is now lower than it was back here on January the 2nd. And you can see we've gone from 330 almost, in other words, 3.3%, all the way down to 2.5 in this move. It's a total collapse of interest rates. Now, what does that do to things such as commodities? We saw what gold did. This is what silver did today. It had a little reaction up and then pulled back. And silver isn't nearly as strong as gold. And that is actually a negative for the future direction of the precious metals. Palladium still continues to be strong. This is what copper has been doing. As the stock market has been going up, as the economy has been strong since late last year. Copper has responded positively, but look where it came from. This is the summer of last year. Copper prices fell apart to the bottom in September, bounced a little bit, and then fell to new lows. We did get a C13, and we've been going up ever since. So we've had commodity prices moving up along with the stock market. We are now trying to decide if the stock market is in for a 1 to 4 week pullback. And now we've got interest rates dropping very, very sharply. This is what lumber has done over the same period. Lumber has totally collapsed into late fall and then has tried to respond up along with the home builders. And now it's given a lot of it back. Now, my partner identified the fact that this big drop was getting overdone and overdone and overdone and went much further down than everyone was thinking. And by December 21st, it began its rally up along with lumber, along with copper, along with gold, along with silver. And as of today's action, we are on a green 8 and had a very strong day once again. Okay, let's try to put all this together. We're keeping this short today, but we will do it again tomorrow and on Friday, because the important day is going to be Friday, because that's going to be the close of the week, which means that we're going to get postings on all of those 9s that we saw sometime on Friday at the close. And right in the middle of it, after 2 days of kind of flat action, we had this wild day today. And at one point, it looked like we were rolling over to the downside. Then the Fed stepped in. We went way up, reversed everything. The Fed stopped talking. And in the last hour, the market collapsed again. Collapsed meaning from where it was, with the S&P and the Dow dropping sharply. The NASDAQ dropped sharply, but still closed up for the day. But more importantly is what happened with interest rates and currencies today. A violent action to the downside by the dollar and by those interest rates. Because it just happened, I don't have an explanation other than what I said, which was that the Fed's comments lead everybody to believe, number one, they are so nervous about something that they've taken all possibility of raising rates another time in 2019. And instead of possibly 3 raises in 2020, they've dropped that down to 1. Number two, they've lowered the growth numbers for the US. The reason all of this kind of fits into the big picture that we've got to wait and be very patient, don't flip a coin and say heads, we're going up in the gold market, in the oil market, in the stock market, in the bond market, or tails, we're going down. There's simply not enough evidence. And the best place to be is in as much cash as possible until the end of this week, and then maybe the end of the next week, and maybe the end of the next week, which would be a 1 to 4 week pullback in all of these markets off of all of these 9s. And we will do a more in-depth analysis of what the Fed actually said, and then get a lot of other opinions from a number of economists about this weird move off of what basically the Fed just said, what everybody expected. No change in rates. We're going to keep them where they are today. Well, we knew that, but it was all this peripheral stuff that they said that had this wild movement. And with that, I just want to remind people that many of these indexes we're talking about are in phase 3s or 4s of hyperwaves. Some of them look like they've gone into 5s and maybe 6s, like the Russell 2000. Many of the stocks that you're all interested in, like Netflix, like Amazon, like Google, like Apple, like Boeing, not so much like Tesla, although I like what I'm seeing in Tesla right now. A lot of these FANG type stocks and others like Boeing are definitely in hyperwaves. And Socrates and Leah and I are going to go through them very slowly and carefully from a trading point of view. We're going to look at some phase 2s, 3s, 4s, 5s, 6s, and 7s like GE, which has completed a hyperwave now. And we've got various very important stocks and indexes all the way up and all the way down. And then I am going to spend probably 2 full hours just looking at the 5 big hyperwaves that I've traded over the last 30 years, showing where, when, and why I made decisions to buy and sell along the way as we were going up and going down. And each one of the 5 are completely different than each other, not from a hyperwave point of view, but from my personal point of view. Because when the first one occurred in 1987, I had my own research firm that had nothing to do with analysis of technical things. It had to do with the analysis of mutual funds. When the Dow Jones had its biggest drop on a point basis and a percentage basis up till that time in US history. Since then, we've had bigger drops point-wise, but nowhere close the drop that we had in October of 1987, which was the end of a hyperwave. At the time, I did not know it was going to become a funky hyperwave and then develop an even bigger one after it. But I'll go through exactly what my reasoning was at each point of the way, when I got in, when I got out, and why. Then we're going to take a look at the Japanese stock market, the Nikkei, that peaked in 1989 in December after one of the biggest hyperwaves in terms of amplitude I've ever seen, which was 40x. Depending on how you measure what Bitcoin just did, certainly Bitcoin did it in a much faster way, but for an entire index of an entire country to go up 40x in a hyperwave was unbelievable to watch. And I want to take you through, as we went from phase 2 to 3 to 4, how I knew exactly where the top was in December of 1989 and called that it was then beginning a multi-year drop that would take it all the way back down below the $6,500 level from 38,000. Then we're going to take a look at the dot-com bubble. Now, in each of those 3 instances, including the last one, I was in a different position in my life professionally. There was things I could do and couldn't do. And I want to explain which, with each of these hyperwaves, given what I could and could not do, what I actually did in order to protect clients' assets on the downside and take advantage of the upside. We're then going to look at what happened in 2006, 7, 8, and 9, in terms of what decisions were made at what time, using what securities to completely protect clients' assets in the 2.5 year bear market that took the NASDAQ down 80% and the S&P and the Dow down about 50%. And finally, we're going to look at Bitcoin from my trading of when I saw that it was accelerating in a hyperwave, when exactly I bought, at what price, where I hedged it during phase 3 and phase 4, where I went completely long, and where I sold and how I sold and the dates of the sales. Just so everybody can understand that in each of those 5 over a 30-year period, the same techniques called the archetype hyperwave allowed me to make decisions. The question is what decisions, when, where, why, and how. After we go through that, the 3 of us are going to go through about a dozen active hyperwaves that we find particularly unusual or important that are going on right now that we and a number of other people are trading. And we're going to show you exactly what we're doing, why we're doing it, and how we're doing it. Now, the reason I'm going into all this is because we're getting a lot of people signing up for this weekend, but most of them are people that have listened to earlier hyperwaves. They listened to either the workshop that we had in Las Vegas, and they also listened to part 1 of Hyperwave, where we started getting into not only a lot of examples, but a number of current hyperwaves, and did a little bit about trading. This 2-day webinar is only about trading hyperwaves. And I think a lot of people have misunderstood, thinking that they had to have watched part 1 that we were joined by Socrates on, as well as our workshop, to understand what we're going to be talking about here. You don't. It would be helpful, and we will send you review materials, including a number of vlogs, 3 or 4 vlogs about Consensio that you can get through very quickly, plus several vlogs about hyperwave basics. And if you simply review that material before Saturday, you will be up to speed on everything what we're going to be talking about. Now, other people have written to us and said, I'm not a trader. I'm not really interested in learning a lot of technical analysis. And I don't think I would ever be able to trade hyperwaves, so I don't think this webinar is for me. I think that's exactly wrong. Remember what a hyperwave is. A hyperwave was developed for investors. I use it for long-term trading strategies. But along the way, where you have 2, 3, 4, 5, 6, 7, 8, 9, 10-year phase 1s, and you have 1, 2, 3, 4, we're going to show you some 5, 6, 7, 8, 9, 10-year phase 2s. You've got months and months and sometimes years to make sure you're on the right side. It's not like trading jumping in and out of. It's taking advantage of this long-term pattern each step of the way. What should you be thinking about? What should you be doing? You don't need to be a trader to get a tremendous amount about what does the world look like right now through the lens of hyperwave, relative to the big picture of debt, but relative to how that debt is affecting all these indexes around the world, as long as a number of sectors, a number of industries, and literally hundreds of stocks. And if you get the basic points, you can simply buy and hold any of those things through phase 2, 3, 4, and get out of them before they go into 5, 6, and 7. So with that, I'm going to turn it back over to my partner. And thank you very much for listening. We hope to see you on Saturday and Sunday. And Leah, do you have anything to tell folks about what they need to do?
Yeah, I'm surprised you weren't laughing at me because I know you saw me eat a popsicle and like easily a whole bag of gummies. So what they should do is totally munch as much as I'm doing right now. Okay, no, I showed the website while you were talking.
Yeah, I saw that. Thank you.
Oh, cool. Yeah. Oh, so you totally can see what I'm doing while you're talking. That's bad news.
Exactly.
Yeah, I think the misnomer was just that which Tyler cleared up, and I changed the title, is that you don't need to have watched Hyperwave, the first one that we did. And I think I don't mean to speak for Tyler, but one of the biggest reasons we decided to do or call it even part 2 is because of all the really, really good questions that we got. And when we brought Socrates on at the end of the first Hyperwave, we were focused on trading. And then we got a lot of great feedback and response about just how incredible that was and interesting. So that really started off our impetus and desire to launch this one about how to trade Hyperwave. So it's not that you need to do part 1 to do part 2, although there's a discount for that. So you can email me directly if you want to buy both. But this one's really focused on trading. So it's different, but again, for everybody that watched the first one, I took all your questions down. Thank you so much for sending. And so hopefully we're going to be answering a lot of them. As for what else is going through my crazy head today, my brain is fried. We will definitely do other vlogs because I think that personally I'm really interested in FedEx is tanking. I think that that's really fascinating. Obviously, a very important metric for the economy. Other aspects of what the Fed is talking about, and I think that there is just obviously a very negative tone of worries about the economy, what the Treasury yields look like today. UBS actually said like a couple hours ago, they admitted that they had like one of the worst quarters ever. You're looking at certain interesting hedge funds that are talking about how they're going into gold and getting out of equities and why they think that that's the investment of a century. I was reading today about muni bond quant funds, which, to be honest, I think is actually a very interesting topic in itself. When you think about the economy, I know that everybody thinks it's sexy to talk about HFTs and quants, but usually everybody listening, and Tyler can agree or disagree, but they don't do as great as everybody thinks. And even though Lewis talked about it in a great book, he's an absolutely incredible writer, and they were totally novel, but quant funds don't always overperform everybody else. That is not true at all. But what's very interesting on what the recent news is that for the most part, and actually as Tyler remembers, I was recruited by Goldman to be a muni bond trader and thought it was the most boring thing in the entire world, which is also why I didn't go that route. But what's interesting is that the quants are getting into it now, and they see it as a different game, not fundamentals, but actually from a TA perspective, and that they can do it that way. So I just think a lot of really, really interesting things going on. So a lot of things to talk about. So thanks for keeping it short today. And I think we'll keep hitting it as often as we can this week, because there's just a whole lot going on in the world. With that said, goodbye, everybody.
Great. Thank you very much. Bye-bye.